Management Accounting C370. So in this video we'll be looking at the activities related to Unit 1. When it comes to the first activity, the key facts are that the name of the business is Jacob's Ladder and the present situation is where their capital employed is £10 million with 15% per annum of return on investment. And the opportunities they have currently are that there's possible additional investment worth £2 million, and the lifetime of the investment is going to be 5 years, whereas the average net profit from investment is going to be 14% of the original investment, and the division's cost of capital is 12%. Based on the information given previously, you got to calculate the residual income before and after the investment. So in general, residual income is equal to the profit minus the cost of capital. So before the investment we have 10 million worth investment, out of which the return on investment is 15%. So the profit will be 1.5 million, whereas for the additional investment we get a return of 14%, which is 2 million into 14%, that is equal to 0.28. And so after the investment we'll have a total of both of them. And from that, when you deduct the cost of capital, which is 12% of the investment, you get the residual income, which is 0.3 million for situation before the investment, 0.04 million in the case of the additional investment, and 0.34 million after the investment. Considering the other activity, that is, when it comes to businesses, a business that we are considering is division of the China group. The present situation is that the capital employed is 10 million, return on investment is 15%. Possible opportunities are that 2 million worth additional investments and lifetime of 5 years, average net profit from investment worth 280,000 per annum after depreciation, and the cost of capital worth 9%. So the question asks us to calculate the return on investment and the residual income for the original, additional and total net level of investment. Once again, the residual income will be the profit minus the cost of capital, and the return on investment will be the profit divided by the capital employed into 100, and in this case when you calculate the return on investment you got to consider profit before tax, that is the profit after depreciation. Considering another question, that is where we have a business which is a business with investment centers, and that's actually green division of Primary Corporation. So the current controllable investment is 750,000 with a profit of 150,000, whereas the available opportunity is to invest 100,000 and earn a profit of 15,000. And the condition of accepting the opportunity is if the ROI exceeds the cost of capital of 12%, then you got to accept it. Based on this, you're supposed to calculate Green's ROI currently for the additional investment after the investment. And when it comes to current ROI, it will be 20%, and from additional investment you get 15%, and totally after the additional investment you get 19.4% on average. Considering on how will Green and Primary Corporation with this investment opportunity, actually Green may not want to accept the investment because it decreases the divisional ROI. But for Brahmi Corporation, the project is better than the cost of capital because the project gives a return of 15%, which is greater than 12%, which is the cost of capital. Therefore, this will increase the shareholder value. Considering about the effect of the new investment opportunity on Green's residual income, currently the residual income is 60,000. With the additional investment get 3,000, which leads to 63,000 residual income after additional investment. So according to residual income, both Green and Brahmi Corporation see an increase and they will support the investment. In our next video, we'll be looking at cost control or the controllability concept in management accounting.